where we are green across the board. Did you know that we are 6 months since the Trump tariff tantrum, if you want to call it that, in the markets, his so-called Liberation Day? The S&P low was 48.35. 48.35. We're almost 2,000 points above that. Man, we've come a long way since then, and a lot of it has to do with tech, AI. As everybody knows, the technology sector is up 60.5% in 6 months.
So from the date of President Trump's inauguration through that April low, the semiconductor industry was down 31%. I really feel that the semiconductor industry was at the heart of what would be most punitive surrounding the president and the administration's introduction of these tariffs. Subsequent to that, the relief that has been offered, the deal in May that was made with the Chinese to extend out 6 months, and let's remember, in November, they're going to attempt to probably extend that again. But now you have semiconductors up 84% since that April low. And semiconductors in 2025, they're just so critical to mobilizing the economy and the AI story surrounding data center. And I keep suggesting that's probably your lead indicator to know if we're ever going to reach some inflection point. And they're not rolling over right now, which means to me we're melting up through the end of the year.
You know what's bananas? Bryn, the intraday low on the NASDAQ from the so-called Liberation Day or whatever, was 14,784. Let's just show the NASDAQ now. I mean, you just have to see the numbers to fully process it. We'll call it 23,000 in 6 months, from the low of 14.7 to 23.
Yeah, I mean, I think it tells investors one thing is you don't want to interrupt, as Charlie Munger said so brilliantly, you don't want to interrupt the power of compounding if you don't have to. And I think that people that got shaken out of the market, once again, have that tough decision of when do I get back in. And I think to Joe's point, the semis are definitely leading, but there's just been this huge thrush higher. Money markets haven't come off the sidelines. I don't think they ever do, and I don't think it really matters. That continues to build. And so I think this is going to be a really important Q3 earnings for the tech sector, because I think that the one company they're all going to be talking about is the one private company, OpenAI, which doesn't have to report earnings. And so I just am so excited to hear about, are they going to have their Oracle moment and just massively increase CapEx, or is there going to be some sanity with the big hyperscalers and cloud service providers of still just like focusing on spending free cash flow, still having strong margins? Or are we going to see this start to melt up in terms of more CapEx spending?
Yeah, I mean, probably the latter, I think is a good bet. The Dow from 36 to 46K in 6 months over that period of time. It says more about maybe where we were than where we've come to, because, you know, the market got so rattled by the extreme nature, I think it's fair to say, of the tariff rollout that day. And here we are. We fought our way back, and now we're finding almost every day we're the news cycle's dominated by these AI deals.
Yeah, and there's some that are working but just don't get the headlines. Take a look at CAT today, up over 4%, hitting another new all-time high. At 507. Take a look at where it was during the tantrum. It was under 300. So we're seeing these type of moves, and you could argue while AI has been very news linked and momentum linked, that what's the story with CAT? So CAT, to me, is playing off lower interest rates, playing against increased onshoring, things like that. So you can find ways to make money. But look, I said coming into this year, I probably said going into last year as well, that I still want to be in big cap tech. And what you're seeing with AI is just a massive, massive adoption that is unrivaled by any other point in history. So to me, one of the best ways to play this, because you're outpacing fundamental valuation. Joe T's strategy is perfectly geared for this kind of environment, momentum strategy. So you got to pay attention to momentum for sure.
We'll talk later about a number of names within the Joe T that have just reached, I think, new highs. We'll give you all those names later. What's interesting is that investors have their eyes on the prize, so to speak. You know, that's AI spend, the pot of gold at the end of the rainbow, lower rates, all of the benefits of that, you know, I wonder if there's a level of complacency at all of the rise in gold, which seems unabated. Up again today, we can show gold. It's firmly above 4,000, right? Yesterday, first time ever, 4,066, where it is. Ken Griffin talking about that, what the statement in that is, if you will, whether it's a conclusion that the U.S. is less reliable, dollar down, gold up, Bitcoin up. I mean, that's out there. Market doesn't seem to care. Investors don't seem to care about much because the market continues to go up.
So to answer where you started, is there some complacency? Probably. However, Scott, I think we're going to go further, and Joe touched on this when he said there's probably a melt up into the year end. We know, and I think, Joe, you said this, we know a lot of people did raise cash immediately after the Liberation Day announcement, and they're probably regretting it now. And if you're a professional money manager, you have to catch up. And the only way to do that in a market like this is to put money to work. Now, regarding gold, which is on the on the minds of a lot of people, and in fact, we were discussing it at Cerity Partners this morning. If you're not in it right now, I don't think you have to chase it because of what Joe and Steve and Bryn and I are saying right here. There are so many ways to make money in this market. Technology stocks are making a lot. In fact, if you look at an Oracle or an NVIDIA or whatever, they're making at least as much, if not more, than gold. So it's not just gold. It's not just Bitcoin. It is an everything rally. And if that reflects that inflation is coming on the back of lower interest rates, maybe interest rates that shouldn't be lowered as much as they are going to be, so be it. Assets are inflating. It's not just gold. It's not just Bitcoin. It's stocks. It's a lot of things.
And that's the critical point, is that, and that's where the canary's sitting firmly in the coal mine, long distance from where the mine opens, which is inflation. So inflation has sort of like reached a bottom because of, it's still 1% above where the Fed wants it to be, and all signs are that it's going to accelerate. And I say all signs are because you hear companies talking more and more about it, and that they can only take so much in costs out, and then suffer so much of the price issues rather than passing on to consumer, because that's not sustainable. So I think you will see prices go up until the tariff wars are settled, and right now it doesn't look like there's an end. So inflation, in my view, is going to accelerate meaningfully, but right now it's party on.
And we'll see, Steve. Maybe it does, maybe it doesn't. I don't know. But I also think there are some esoteric reasons that need to be discussed in terms of gold's rise. I happen to agree with you. I think you agree with me that gold is reflecting an inflationary environment. But it also could reflect some geopolitical things, such as the fact that we did freeze Russian assets after Ukraine. And there are countries out there that have moved their reserves from the U.S. dollar to gold. We know that. I don't think the dollar is going to lose its reserve currency status simply because there's no replacement. But there are other, as I said, esoteric reasons, and this also applies to crypto as well, which some people look as a potential 21st century hedge. Just remember, there are these wallets that are big wallets, whales that can any point in time liquidate, so you just have to be aware of that. If you're going to use it as a hedge, it has to be a very long-term hedge.